What if you could see the cards before they were played? Not all of them, but just a few. A peek at what the people who run the companies, the ones sitting in the boardroom, are doing with their own money. That's the fantasy, right? The ultimate edge.
It's the siren song of Wall Street, Murph. The idea that there's a secret, an inside track. And for 7 days, I decided to chase that song. I set out to trade, legally, using only the publicly disclosed trades of corporate insiders and politicians to see what would happen.
Okay, hold on. This is the part where the lights flash and the big warning sign appears, right? We have to say it.
We absolutely have to. Let me be crystal clear to everyone listening, this was an experiment, an educational exploration. Nothing you hear today is financial advice. We are not investment advisors. Every single person's financial situation is unique, and you should always consult with a qualified professional before making any investment decisions. This is for entertainment and informational purposes only. Seriously, don't just go and copy what I did.
Alright, disclaimer delivered. Now, Cooper, unpack this for me. When you say you traded like an insider, you're not talking about getting a shady tip in a parking garage. How does this work legally?
Exactly. The irony is that insider trading is legal, but tracking what insiders are legally required to report is not only possible, it's a cornerstone of market transparency. The key is the SEC's Form 4. Whenever a corporate insider, we're talking CEOs, CFO, board members, or anyone owning more than 10% of a company buys or sells shares of their own company, they have to file this form with the Securities and Exchange Commission, usually within 2 business days.
So the information is public. It's out there for anyone to see. But is it easy to find? Is it buried in some government website that looks like it was designed in 1998?
It can be. The SEC's Edgar database is the primary source, and yes, it's not the most user-friendly interface. But thankfully, we live in an age where data aggregators do the heavy lifting. There are several websites, some free, some paid, like Open Insider, Finviz, or MarketBeat, that scrape this data and present it in a clean, searchable format. You can see who bought, what company, how many shares, and at what price. For the political side of things, there are sites like Quiver Quantitative that specifically track the disclosures of members of Congress.
So you have the data stream. You can see the trades. What were your rules for this 7-day experiment? You couldn't just throw a dot at every single Form 4 filing, right? There must be thousands.
That's the crucial first step, creating a framework. Rule number 1 was that I would only focus on informative buys. That means I ignored a ton of the noise. For instance, I ignored all insider sells *.
Wait, why? Wouldn't a CEO selling 1 million shares of their own company be a massive red flag? Like the captain jumping off the ship?
It seems that way intuitively, but the data suggests sells are much less predictive than buys. An insider might sell for 100 different reasons that have nothing to do with the company's future prospects. They might be diversifying their portfolio, buying a house, paying for their kids' college tuition, or exercising stock options and immediately selling to lock in the cash. There are just too many variables.
But a buy is different.
A buy is usually for one reason and one reason only. They believe the stock is undervalued and is going to go up. They're taking their own, post-tax money and putting it on the line. That's a powerful vote of confidence. So, Rule 1, only open market buys. No option exercises.
Okay, that makes sense. What else?
Rule number 2 is to look for signals of high conviction. I wasn't interested in a vice president buying a token $1,000 worth of stock. I was looking for significant buys, either in absolute dollar amounts, say over $100,000, or as a significant percentage increase to their existing holdings. And even more powerful is what's known as a cluster buy.
Cluster buy? Sounds like something you'd order at a candy store.
Shuckles. It's when you see multiple insiders at the same company all buying around the same time. If the CEO, the CFO, and 2 board members all start buying stock within the same week, that's a much stronger signal than just one person acting alone. It suggests a shared belief within the leadership team that something good is on the horizon.
It's a consensus. It's the leadership team basically having a meeting and then all walking out and logging into their brokerage accounts.
That's the story it tells. My final rule was about the timing. Once I identified a trade that met my criteria, I had to execute my own trade on the following market open. I used a small, fixed amount of capital for each trade to keep the experiment controlled. I wanted to see the pure performance of the strategy itself, not get skewed by betting big on one idea.
Alright, the stage is set. The rules are clear. Day 1. You're logged in, you've got your coffee, you're scanning the data. What did you see? What was the first move?
The first thing I noticed was the sheer volume of data. It's like drinking from a firehouse. But filtering by my rules helped a lot. The first signal that really caught my eye was in the biotech sector. This is a classic area for this kind of strategy because information asymmetry is huge. Insiders might have a much better idea of how clinical trials are progressing on before the market does.
Right, they know if the lab results are promising or a dud.
Precisely. I saw a cluster buy at a mid-cap biotech company. Let's call them Biogenics Therapeutics for this discussion. They are not one of the huge names like Pfizer or Moderna, but they have a promising drug for autoimmune diseases in phase 2 trials. The CEO bought about $250,000 worth of stock. A day later, the chief scientific officer bought $150,000 worth. And 2 board members made smaller, but still significant buys.
That's your cluster buy. The whole gang is in on it.
Exactly. It ticked all the boxes. It was a high conviction, multi-insider buy in an information-sensitive sector. So, on Tuesday morning, at the market open, I bought a small position in Biogenics. And then nothing happened.
Laughs. Of course. The market doesn't just instantly reward you for being clever.
It actually dipped. It went down about 5% that day. And this is the first major psychological hurdle of this strategy. You see these smart, informed people making a big bet, you follow them, and the market immediately tells you you're wrong. The temptation to second-guess yourself, to think maybe you missed something, is immense.
So what's the explanation? Why would it dip if the insiders think it's a great buy?
The market is a complex beast. There could have been broader market weakness that day, maybe some negative news about a competitor's drug, or just random noise. The key takeaway here, which I had to remind myself of, is that insiders aren't day trading. They are investing based on a medium to long-term thesis. They believe the company will be worth more in 6 months or a year, not necessarily in 6 hours. So I had to force myself to hold on and trust the signal.
So you've got this biotech trade that's underwater on day 1. Did you start looking for the next signal? Or were you glued to that one stock?
A bit of both. I set an alert for any major news on Biogenics, but my job was to find the next trade. This is where the political angle came in. I switched over to the congressional disclosures.
Oh yes. The Washington D. T. Insiders. This feels even more controversial.
It is. The law here is the Stock Act of 2012, which requires members of Congress to disclose their stock trades within 45 days. The idea is to prevent them from profiting off non-public information they gain through their work on committees or from classified briefings.
For 45 days, that seems like a lifetime in the market. The Form 4 is 2 days. A congressperson has more than a month to report a trade.
That's the single biggest criticism of the Stock Act. The reporting lag is significant, which can make the data less timely for trading purposes. However, many members report much sooner, and the patterns are still fascinating. You can see which sectors certain politicians are consistently investing in. For example, members on the House Armed Services Committee might be trading defense stocks, others on finance committees trading regional bank stocks.
So it's less about a specific catalyst and more about following the smart money in a sector they directly oversee.
That's often the case. I found a disclosure from a representative who sits on a key infrastructure and energy committee. They had made a significant purchase in a major U.S. steel manufacturer about 3 weeks prior. Now, normally that's too old for my rules, but it was interesting because there was a lot of chatter at the time about a new infrastructure spending bill being debated.
So you're connecting the dots. The person who helps write the rules for infrastructure is buying a company that provides the raw materials for infrastructure.
Exactly. It's not a smoking gun, but it's a powerful piece of context. The steel company's stock had already run up a bit since their purchase, but the thesis that more infrastructure spending would benefit domestic steel still held. It felt like a low-risk, more macro-level play compared to the high-stakes biotech bet. So, on Wednesday morning, I took another small position, this time in the steel company.
So now you have 2 positions. One is a high-risk, high-reward bet on a drug trial, and the other is a slower, politically influenced bet on American industry. A diversified portfolio of insider trades.
In a way, yes. And the steel trade almost immediately went my way. It ticked up about 2% over the next 2 days. Nothing dramatic, but it was a nice bit of green that counteracted the red from the biotech stock, which was still just treading water.
Let's talk about the big one. Tech. Specifically, AI. That's been the story of the market for the last 2 years. Were you seeing any insider activity there? Everyone wants to know what the execs at Nvidia or Microsoft are doing.
That's what I thought too. But here's another crucial lesson: the most obvious plays are rarely with the alphas. I saw very few, if any, significant open market buys from top executives at the mega-cap tech companies. They are already so wealthy and their holdings are so vast that a new buy is rare. Most of their transactions are pre-scheduled sales, those 10th of a minute one plans we talked about.
So the real action isn't at the top of the food chain.
Not for the strategy. The signal gets lost. So I had to dig deeper. I wasn't looking for the company making the AI chips everyone knows about. I was looking for the company that makes the specialized cooling systems for the data centers that house those chips. Or the software company that provides a niche data labeling service for AI models. The picks and shovels of the AI gold rush.
The companies that sell to the gold miners.
Exactly. And on Thursday, I found one. A mid-sized company that specializes in high-speed optical networking components, the kind of stuff you need to connect thousands of GPUs together to train a large language model. I saw the CTO, the real tech brain of the operation, make a very substantial purchase. It was his first open market buy in over 2 years.
That's a signal. If the person who designed the tech is suddenly putting a huge chunk of their own cash into the company, that's a statement.
It felt like the strongest signal of the week. This wasn't a CEO or a finance person, it was the person who understands the technology roadmap better than anyone else. I couldn't ignore it. So on Friday morning, I opened my third and final position of the experiment in this networking company.
Okay, so we're heading into the end of the week. You have 3 trades on the books. Biogenics, the high-risk biotech play. The U.S. Steel company, a political macro bet. And this AI infrastructure company, the picks and shovels play. How are you feeling at this point? Was this exciting? Stressful?
It was intellectually fascinating but emotionally taxing. It's a completely different way of thinking about the market. Normally, you do your own fundamental analysis, you look at charts, you build your own conviction. With this strategy, you're outsourcing your conviction to someone else. You're placing a bet on their judgment.
You're trusting the jockey, not just the horse.
A perfect analogy. And you have to constantly fight your own biases. When the AI stock immediately popped 3% on Friday, the confirmation bias was overwhelming. I thought, of course, the CTO knew this is a genius move. When the biotech stock was still down, I started to feel doubt. What if there was bad news I don't know about? What if their trial is failing? You're basically piggybacking on someone else's information, but you're still left alone with your own emotions.
So the week is over. The 7-day experiment is done. It's Monday morning, time to close the books and tally the score. Let's go through them one by one. The moment of truth. What happened with Biogenics, the biotech stock?
On Friday afternoon, after the market closed, Biogenics put out a press release. It wasn't the big news about the Phase 2 trial results, which is what I assume the insiders are ultimately betting on. It was smaller news, but positive. They announced they had secured a new patent for their delivery mechanism. The stock gapped up on Monday morning. I closed the position for a net gain of about 4%.
Well, so the insiders were early, but they weren't wrong. The market just needed a catalyst.
Precisely. It proves the point about their time horizon. My 7-day window was probably too short. If I had held for a month, the gain might have been much larger. But for the experiment, a 4% win in less than a week was a solid result.
Okay, 1 win. What about the boring, old steel company you bought based on the politician's trade?
That was a slow and steady grind. It continued to inch up. There was no big news, just a general positive sentiment around industrial stocks that week. I closed it out for a gain of about 5%. Not spectacular, but a win is a win. It did exactly what I expected it to do, a low volatility upward drift.
2 for 2. You're an insider trading genius, Cooper. This is the part where you sell a course for $999.
Thus, hold on, because this is where reality sets in. Let's talk about the AI networking company. The one that felt like the surest bet of them all.
The CTO's big buy. It popped 3% on the first day. It must have flown, right?
It did pop 3% on Friday. And on Monday morning, a major Wall Street analyst downgraded the entire optical networking sector, citing concerns about near-term demand and inventory glut from China. They specifically downgraded the company I bought from buy to hold.
Oh no. So a completely external event, something the CTO couldn't have possibly predicted, just blew up your thesis.
It created the stock at the open. It fell about 9%. My initial 3% gain was wiped out, and I ended up closing the position for a loss of around 6%. And that right there is the single most important lesson of the entire week.
Which is?
An insider signal, no matter how strong, does not make a company immune to broader market forces, sector-wide sentiment shifts, or just plain bad luck. The CTO's buy might still be a great long-term bet. He probably saw that analyst downgrade and thought, these guys don't get it. Our next-gen product is going to blow away expectations in 6 months. But in the short-term world of a 1-week trade, I got burned.
So let's tally the final score. You had a 4% win, a 2. 5% win and a 6% loss. After all that work, all that data analysis, you basically came out
Just about flat. I think my total portfolio for the experiment was up something like 0. 15% after closing all 3 positions. It was a whole lot of work for basically nothing in terms of profit. But the profit wasn't the point. The lessons were the profit.
So what are the big, overarching takeaways from your week as a pseudo insider? If someone listening is intrigued by this, what should they know?
First and foremost, this is not a get-rich-quick scheme. It's not a crystal ball. It is, at best, a powerful tool for idea generation. Seeing a cluster of insider buys can be a great reason to start researching a company you've never heard of. It's a starting point, not the entire analysis.
So you can't just blindly copy them. You still have to do your own homework.
You absolutely have to. You need to understand what the company does, why the insiders might be bullish, and what the risks are. The analyst downgrade on the AI company is a perfect example. If I had done deeper research, I might have seen that the sector was facing headwinds and decided the CTO's buy wasn't enough to counteract that risk.
What about the psychological aspect? It sounds like that was half the battle.
It's more than half the battle. You have to have the conviction to hold and when a stock dips right after you buy it, and the discipline not to get euphoric when it pops. And you have to accept that even the most informed people on the planet can predict random market events. The CEO of a company has no idea if the Federal Reserve is going to make a surprise announcement tomorrow that sends the entire market down 5%.
So, the insider signal is a micro indicator in a macro world.
That's a fantastic way to put it. It's a strong signal about the health and prospects of one specific company. But that company doesn't exist in a vacuum. It's floating in the giant ocean of the global economy, and it can get tossed around by waves it can't control.
It also seems like context is king. You can't just look at the dollar amount. You have to know if it's an urban market buy versus an option, a single buy versus a cluster, a tech guy versus a finance guy. The nuance is everything.
Everything. A $1 million buy from a billionaire CEO is less interesting to me than a $200,000 buy from a chief scientific officer who has never bought shares before. The first is a drop in the bucket, the second is a massive statement of conviction. That context is what separates a real signal from just noise in the data.
After this whole experience, would you ever incorporate this into your personal, long-term investing strategy? Not as a whole strategy, but as one tool in the toolbox.
Absolutely. I will never again make an investment without first checking the insider trading activity. It's a free, valuable data point. If I'm already bullish on a company for my own reasons and I see a bunch of insiders are buying too, that's a huge confidence booster. It helps validate my own thesis.
And what if you love a company, but you see the insiders are all selling?
That's where it gets tricky. Like I said, sells are noisy. But if I see the CEO, CFO, and COO all have pre-scheduled temp of a one plans selling millions of dollars of stock every month for the next year, it doesn't necessarily mean the company is doomed, but it tells me that the leadership is systematically cashing out. It might make me temper my expectations for explosive growth. It's another piece of the mosaic.
So, in the end, trading like an insider for a week didn't make you rich, but it did make you smarter.
Infinitely smarter. It taught me that there is no single magic bullet in investing. The real edge isn't finding one secret piece of information. The real edge is the hard work of synthesis of taking all the available information, the fundamentals, the charts, the sentiment, and yes, the insider signals, and weaving them together into a coherent thesis. The insiders give you a powerful clue, but they don't give you the whole answer. The rest is up to you.
An amazing experiment, Cooper. It pulls back the curtain on a part of the market most people only hear about in movies. And it proves that, at the end of the day, there's no substitute for doing the work.
And definitely no substitute for remembering that this is not financial advice.
Laughs. We had to get one more in there. Alright, thanks Cooper. This has been fascinating. I can't wait to see what you cook up for the next experiment.
We'll see. Maybe I'll try trading based only on astrology for a week and see how that goes.
I think we both know how that will go. But I'd still listen. To everyone out there, thanks for tuning in. We'll see you next time.